had the great pleasure of working with PowerOptions for the past 8 years. I handle a lot of the coaching sessions and education on the site. I've co-authored 2 books with Ernie on options investing, one on naked puts and one on protective option strategies. Now, PowerOptions, of course, is a patented suite of search and analysis tools designed for self-directed options investors. We do support over 23 different strategies. I am versed in all strategies on the site, excuse me, but there are certain strategies I do not trade in my personal account. Things such as, things such as iron butterflies, short straddles, short strangles, and naked calls don't match my personal risk-reward tolerance, so I do not enter those trades. But if you have any questions about those, go ahead and send them over. I can certainly show you how to use the tools to identify positions in those strategies or discuss some of the potential adjustments or management techniques on those strategies as well. All right, now the processes and procedures for today's presentation. Use the question pod over on the right-hand side to send any questions that you have over to me. Please feel free to ask as many questions as you want. We may not have time to answer all the questions. That's usually not a problem. Usually if we need to, the schedule for today's presentation is from 4:30 p.m. Eastern to 5:30 p.m. Eastern time. But if we still have questions hanging out there or questions I think need a more detailed explanation, we'll stay maybe till 5:45, 6 p.m. Eastern time to handle those questions. Now the questions can be about the tools on PowerOptions, RadioActive Trading, PowerOptions Applied, or just general options strategy and education as well. So really feel free to ask anything you want to. And if you want to throw me any questions about British literature or paleontology, for example, I guess I can field those as well. All right, the basic ground rules. Don't be shy. Ask as many questions as you want. The pressure really is on me. There are no stupid questions. There are only stupid answers. So please ask any questions you have. It's designed for you to have a forum to have your questions answered. So go ahead and send those over to me. Be patient, of course. There might be a few questions ahead of yours. As I mentioned, I'm going to make sure that we get through all the questions that have been asked. We're going to try to get through them all. And I do encourage everyone to help us or help myself, help others. If I'm answering a question based on my personal trading experience, and your personal trading experience has something an additional to offer, you have a different comment, use the question pod to send that to me, and I'll take care of that as well. Most important, let's have fun. Let's just get some good education, and we'll be on our way into the weekend. With that, I'm going to navigate over to the PowerOptions suite of tools, and very quickly, we're going to start off this presentation the same way we start off every presentation. And to begin with, what I'm going to go ahead and do is we're going to just run a weekly search we're going to run a search in the naked put strategy for weekly options, just to see if there are any new securities that released weekly options. Now remember, the weekly options, the new series, are released at the beginning of released Thursday morning before the following week. So next week's options, the options that expire next Friday, were released yesterday morning. At our last count, during our last open discussion presentation, we had 60 total securities, stocks, ETFs, and indexes that offered weekly options. So let's see what we have today. So we're going to go into the naked put menu. We're going to go right into the search screen. And we're going to see which searches come up. Gary, hi, how are you doing? All right. Okay. So we've got the search here. And this is one of the default searches, very limited results. What I'm going to do is scroll down to the very bottom of the screen. We're going to hit clear these settings. It's going to empty out every one of the listed criteria for the default menu. We're going to run a search for all months. We're going to set our expiration time frame to all months. And I'm going to set my days to expiration field to be between 2 to 9 days in expiration. So that will cover next Friday's expiration. Now I know that there's going to be multiple strikes for each security that offers the weekly options, so I'm going to restrict the range to just show me one strike out of the money. So when the show in the money, show out of the money field, I'm going to select number of strikes 1 to 1, so we don't get listed repeats. And I'm going to scroll down to the bottom and make sure I have no list selected to begin. And that's all we're going to screen for. So let's go ahead and hit submit. Let's see our total number of weekly options that will expire next Friday. Well, how about that? We've got something new today, don't we? Last week, we knew that we only had 60 results. Today, there's a total of 72 securities now that offer weekly options. So another 12 securities were released on Thursday morning, which offer weekly options. Now just looking at the list here, I think I see one. NVIDIA, I don't think was there before. I'm not sure if Qualcomm was. Yeah, they might have been. They were in the last batch, I believe. Oh, I do have two results for IWM, the March and the April. That's interesting. That's very interesting. This option here, notice at the bottom there's one that says it has 6 days left to expiration. I think that's a erroneous piece of data. That's very interesting. So maybe it's only 71. But let's move on to the next screen. Let's see what stocks we can see there. I was kind of looking through to see if I have any additional listings. Multiples of SPY. Why is that? Maybe there aren't more. I'm seeing some of these options with 6 days. I know why. I apologize. I'm smarter than my own good. These securities that we're seeing here, XLE has an option that expires in 6 days. SPY, if we check here, it also has a series that expires in 6 days. Didn't dawn on me what that was. That's actually showing us the quarterly options as well. So we probably do only have 60 options or 60 securities still that have weekly options, but we have several securities that have quarterly options, another dozen securities that have quarterly options that will expire on the 31st. So I caught myself in my own screen. Well, let's try to do this. Let's limit our days to expiration to be between 6 to 8. See if we can filter out those quarterly options. And we did, and we're back to 60 results. Okay, so that was my own fault. There are still only 60 securities now that offer weekly options. So that means there's about a dozen securities that offer quarterly options. Most of the ETFs, for example, and indexes that have quarterly options that will expire on Thursday, the 31st. Okay, so let's go back to the main home tab. We've got a lot of questions coming in. It looks like John has a series of questions all set up in a row. That's great, John. Let's go ahead and address your first question. And the first question is a question that, I'll be honest with you, no one really likes our answer for, but I'll give the answer anyway. John wants to know, what is the expected return per month or per year for the radioactive trading approach? There really is no expected return. And I'm not trying to dodge the question, John. The radioactive trading technique is not a set list of parameters where I'm only trading stocks that have this specific criteria, where I'm always doing a put that has this exact risk and is this far out in time and has this percentage. The radioactive trading technique is a way to limit your risk that can be applied on top of your own stock selection. I can't answer what is the expected return because the expected return for Kurt, who likes to use the IBD 50 stocks and the CanSlim stocks when he runs his personal search, the income methods that he prefers to use are completely different than the types of stock I select for the radioactive trading technique and the type of income methods that I use. That's one of the advantages of having 10 different income methods available to adjust your position once you've opened that initial married put. Now, I look for different stocks. Sometimes I trade dividend-paying stocks. Also, sometimes I prefer, based on my account size, I'll only trade stocks, let's say, that are under $35, under $45 per share. So I use a different set of criteria. So it's hard to gauge. There's no one way to tell what is an expected return. What I can tell you personally is that the radioactive trading technique has matched my goals, my personal monthly goals for return, and, of course, keeping my capital, keeping my gains by not giving back to the market. I'm still able to average about 2 to 2.5% return per month in a bullish market using the radioactive trading techniques, and I have to make a comment on that in a second. In a neutral market, I still feel that I'm able to generate about 1 to 1.5, maybe 0.5 to 1.5% per month with the different income methods, and in a bearish market, I can still generate income, but keep in mind I'm still losing on the stock price. So the question is, yeah, if I generate 2% using an income method in a bearish market, my stock has dropped 4% and the put has protected me 2%. Would I say that's a positive income? Well, that depends on you, how you like to track income and return on your position. The total position as a whole might only be down 0.5 or 0.1%, even though I did generate income. Now, the first comment I made about in a bullish market or a neutral market that I'm able to average, my personal goals, what I'm looking for, that doesn't mean that every month by month I'm making an adjustment. When I first opened the married put position, the RPM, let's just go to the married put home tab there. When I first opened the position, I do need to wait for the stock to move before it makes sense to apply one of the bullish income methods. Income method number 1, number 3, number 4, maybe number 5, or number 6. If the stock doesn't move in that first month, if it doesn't move to where it makes sense for me to apply one of the income methods following the rules in the blueprint, that's okay. If I'm still expecting it to move up, the next month I might be able to perform an income method that'll generate 3 or 4% against my position. So over a 2-month period, I met my average that I'm looking for, my personal goals of maybe 2%, but I'm not necessarily doing that month by month. This is the average when I close the position or when I reach my goals and liquidate the position has been met over the course of that time. But you don't want to force yourself into an income method too soon, because that can have a disastrous result on your RPM. Okay, so that's the best way, John, that I can answer that question. There is no one expected return. I'm able to match my personal goals. This, I'll be honest with you, this is not the strategy, and we would never promote this strategy as, oh, you're going to be able to make 5-6% per month. Any strategy that claims you're going to be able to make 5 to 6% per month and you could compound that and make 100% per year, those are the situations you find yourself in where, yeah, sure, 1 month you might make 5 or 6% on your trades, and then the next month you might have gained 4 or 5% on 8 of your positions and lose 20% on the other 2 positions and find yourself right back to break even. What we promise with the married put technique is if you follow the rules in the blueprint, you can establish it so that you'll never lose more than 5 or 6% or however you set it up on any given position, and you have the opportunity to let the winners run and the 10 income methods to make those adjustments. Okay, second question. Is there a way to use the radioactive trading approach using leaps instead of stocks or ETFs? If so, what is the respected return? Yeah, again, in the blueprint, Kurt discusses some of the ways of looking at he calls it the bulletproof from the beginning chapter and discusses long calls. The problem with substituting, there's 2 things. If you're just trying to use a parity trade and you're just trying to use an out-of-the-money long call instead of the married put setup, you can really run the risk of falling into the lie of leverage. If you're careful, as discussed in the blueprint, you can attempt that method, you can attempt that technique, but you have to remember, if I can only afford to buy 200 shares and 2 put contracts in my account, I can only afford to buy 2 call contracts. I can't get caught in the lie of leverage. What you don't want to do, what I showed in an example for what I showed in the very first slide is, let me go back to that very quickly, ladies and gentlemen. The very first slide I had up here. I apologize, I went to the wrong one. There we go. Let's go back up here. What I'm seeing here, and it's hard to view, and we can do this on a real example, this is a comparison on the same stock. These are 2 screenshots that are comparisons of the same stock, NEM, which is trading at 58.70, of a married put position with an outlay of capital of about $6,959, and our risk was limited to only 6.6%, $460 of that investment. If you try to just substitute an in-the-money leap call in lieu of stock and you create this in-the-money long strangle position over here on the right on the same stock, you see you get trapped in that lie of leverage. Yes, you're only risking $650. You're putting up a capital of $2,650, or a little bit close, a little bit less than a third of the original married put position, but the risk is 25%. You're risking 25% of your invested capital. And as you know, if you allow yourself to suffer a 25% loss on one position, you're going to end up needing a 33 or 34% gain just to get back to break even, and that slope gets more and more slippery as you take higher risks. We never advocate doing the in-the-money long strangle, buying an in-the-money long call and an in-the-money long put, opposed to doing the married put position, the radioactive position. I've written a few articles for customers. They send me a stock and a position and say, isn't this in-the-money strangle better than doing the married put position? And I'll break it down and we'll look at both positions as we are looking here side by side, and then I'll show them the expectations in any normal market, any normal bullish expectation. If the stock moves up 5% from when we got into both of these positions, the in-the-money long strangle will still have a loss, an unrealized loss, but you'd still have a loss in the position because the gain in the call wouldn't counter the loss on the put option. But in the married put, you still have a positive delta, so you'd actually be able to liquidate for a profit of maybe 2.5%, 3% if the stock moved up 5%, where you'd still be at a loss at the in-the-money long strangle. So we don't advocate that technique. And also when you sell a call, if you're just looking at income method number 1, when you sell a call against the in-the-money strangle, remember you don't actually own stock yet. So the delta of having an in-the-money long call, an in-the-money long put, and the short call, it creates a similar risk-reward graph, but it doesn't exactly perform the same way because you don't own stock yet. You have the right to own stock. All right, John is continuing the vein of questions here, looking for a percentage return. And he wants to know, what is the expected return per month or year for credit spreads? Well, that depends. And the secondary follow-up question is, what is the expected return per month per year for iron condors? Well, that depends on how you set it up, John. And there are multiple ways to answer that question. For example, let's just go into the bear call credit spread position. And we'll go into the search function. We'll just pull up a basic default search. All right. Now, I'm seeing a lot of leverage returns here, and this is just a basic default search for credit spreads, not recommendations or suggestions. We see a return here of 33%, 38% almost, 28%, and so forth. Well, let's scroll down to the bottom and take a look at what we're identifying here. This particular screen is looking for only those bear call credit spreads have a minimum return of at least 5%, are at least 5% out of the money. The short call is at least 5% out of the money, and stock price greater than 15. There's not a lot of criteria. Oh, we are looking for stocks that are in a current downtrend. So we're looking for bearish stocks to match the trend because we're in the bear call credit spread. Now to be safer, let me scroll back up to the top here. What don't I have? I don't have the probability selected, so very quickly let's do that. I'm going to click on the See More or Less Columns button here up at the top of the screen. And let me go ahead and select the percent probability. Did I just pass that? I apologize. I think I just skipped right over it. There it is, probability below. Okay, so let's save and return. Close the window. All right, so now we see a problem. Yes, we have a lot of leverage returns here. Positions on the VIX, of course, but look at the probabilities. 56% probability, 62%, 70%. Now, that's not what most people who are looking for a credit spread will do. What we'll typically look for are spreads that have at least a 75 or 80% probability of success, and you'll probably use other stock filters as well. But let's just put that in. In addition to being 5% out of the money, I'll increase that to 7 as well to be safer. I want a better probability of earning that full return on the bear call credit spread. And I'll still keep it about 5% return, but we want a probability of at least 80%. So let's go ahead and run that search. Now this is a common criteria that's used, looking for a probability of greater than 75 or 80%. But let's take a look here. So now we're seeing more returns of around 15%, 12%, 11%. Is that possible with the credit spreads? Is even some of those positions we saw with the 33% return, which is based on the net credit divided by the maximum risk, is that possible? Yes. Is it likely that you're going to get that every month? No. Is there another problem with this? Absolutely there is. Let's just take this first trade, and it's on one of the 3 times ETFs, which I probably would never trade in a bear or bull put credit spread anyway. Those of you that are doing that and having success with it, congratulations. I don't typically trade the 3 times positions. I think there's even 4 times positions now. But on this particular one, FAS is at 29.68. We're shown that we could sell the April 33 call for 31 cents and buy the April 34 call for 18 cents. So the maximum credit is 13 cents, which means the total risk on the position, my difference in the strike prices minus the net credit, would be 87 cents or $87 per one contract. Let's just take a look at the profit and loss chart. We do have an 80% probability of success. What does that mean? Well, let's just assume straight math, and the market doesn't always work this way, but let's just assume it in this fashion. Here's our risk, maximum return of 13 cents per one contract. Naturally, we'd probably trade 10 or more contracts so we can have a reasonable net credit. And we're risking $87. We're risking about 6 actually almost 7 times more of our possible net credit. It's almost a 7-to-1 risk-reward ratio when looking for positions that have that 80% probability or higher. Usually about 5-to-1 to 10-to-1 is your risk. So if I entered 10 trades with the same risk-reward profile, we did 10 trades where we could make a maximum of 13 cents. We're risking 87 cents with an 80% probability. If we were right 8 times, well, we'd collect, what is that, about $1.04 net credit, 8 times 13? Yeah, so we'd make $1.04 net credit, or $104, let's just assume it that way. And then I lost on the other 2 positions. Something happens and the stock gapped, went above our strike prices. Yes, we'd have management in place, but if it gapped, it'd still go through our stop losses. So let me take that 10. Let's just say we made $1.04, but we lost 87 twice, so we lose roughly, what is that, 174? The loss of 174 in our total positions. What does that mean? Oops, sorry about that. It means we were right 80% of the time and still came out of the month with a loss. So are leverage returns possible with the credit spreads and the iron condors? Remember, the iron condor would be a combination of the 2 positions. Yes, it's possible to find positions that offer a 25 or maybe even a 30% leverage return. When you're looking for a position that has a higher probability, probably maybe looking to make 50 cents, maybe 30 cents, 80 cents of net credit depending on the stock price. But your risk to reward is going to be between 5-to-1 and 10-to-1. You're going to be risking 5 times or 10 times what you're trading. So the expected return, even with proper management techniques in place, is difficult to gauge, because if you have one bad month, if the market turns on you in 1 month and you have 7 or 8 losing positions that unfortunately hit their maximum loss, you've probably wiped out 6 months of previous gains. That's the lie of leverage. These leverage spreads, just like long calls by themselves, can work against you. Realistically, if I have a customer ask me, John, is it possible that I could make 5% per month trading options? Well, it's possible, but unless you manage it actively, it's not probable. And even if you manage it correctly, it's probably not too probable. Ernie always says that, look, if you're expecting 5% return per month, that means you're expecting a 60% return per year. And if you compound that, of course, it would be a little bit more. But just taking the straight numbers, it would be 60% return per year. If you don't expect the market to move up 60% in the year, you shouldn't expect to make 5% per month trading options. If you're expecting that, you're using leverage positions, and you'll find out, unfortunately, pretty quickly how that will work against you, where you can be right 80% of the time and still lose money when you're doing leverage spreads. If you're putting your money into leverage long calls, you can also find out quickly how that will work against you as well. So there's no real way to answer that. What is an expected return? The PowerOptions applied techniques using the different iron condors, they've had 12-month periods where they've made over 60 or 70%. But during the flash crash, anyone who was trading credit spread, well, anyone who was trading bull put credit spreads, bull call debit spreads, or iron condors and had stops in place, that 1 hour moment where the market collapsed and the stop losses everyone had in place to make sure they wouldn't hit the maximum loss in the position, those were triggered so quickly and filled at the worst possible prices that the May 6 flash crash wiped out probably just about every iron condor portfolio. And I don't mean on PowerOptions applied. I mean anyone who was trading iron condors, anyone who's trading bull put credit spreads, anyone who's trading bull call debit spreads, that probably wiped out 10 to 12 months of previous gains in their portfolio. You have to be aware of the risks. When you're doing those leverage spreads, when you're doing those leverage positions, you have to be aware that the percentages work against you. And we've shown this in some of the webinars that Kurt's done recently. If you have math doesn't behave the way we think it does. If you have just straight stock, but you can apply it to any kind of options or any kind of leverage position, if you have a 20% gain and then a 20% loss, are you at break even? No, you're actually behind. If I had a stock at $100 and it moved up 20%, we'd be at $120. If the stock then fell 20%, or my next position, I bought new stock at $100 and it had a 20% loss, my total price that I'd have left after that investment would be about $96. I'd be down 4% because math doesn't behave the way we want it to. So I can't really give you an answer on what is the expected return. For radioactive trading, I can just say it's matched my goals. And I can also say that I've been doing radioactive trading now for 3 years, and this is the only strategy I've found that I've been able to consistently make my goals. I've had some luck with picking the right stocks or going through the process of selecting my stocks, but at the same time, yes, I can find covered calls that make 2.5%, 3% if I'm assigned, but if I'm in a covered call portfolio and I have one stock that drops 15%, I've given back the gains from 7 previous trades. Can't allow that to happen. That's what the married put technique and the radioactive trading technique solves, is that when I'm wrong, I'm only losing 4 or 5%, and I'm still able to make gains minimum of 2 or 2.5% per month. I think standard collars is kind of the same fashion. It has a similar risk-reward profile to a bull put credit spread or a bull call debit spread, but because I'm not leveraging it with the spreads, I'm in the stock in a short call and a long put. On the collar, I might be able to make 2 to 2.5% if I'm assigned, but only risk 5 or 6% if I'm wrong. I still need to be right more often than I'm wrong in order to make money with a standard collar position, but I can manage that easier because I kept my losses down to a reasonable ratio. All right. Okay, I got to move on now. I've got tons of questions. I'm sorry here. I got tons of questions coming in that I got to address. Doug wants to know, just signed up with PowerOptions and Thinkorswim. Likes those in combo, and wonder if you have any insight in how those overlap and relate and can be used in combo. I wish I did, Doug. I'm not really 100% familiar with the tools on Thinkorswim. I haven't tested those tools in probably 4 or 5 years. Looked at their offerings and what they have, so I'm really a poor subject. This is really a bad answer, but I'm really a poor subject to inquire how they could overlap. We were in talks to work with Thinkorswim a few years ago, but once they got bought out by TD Ameritrade, they decided they didn't want any other third-party customers linking to their tools. I know a couple of customers, Doug, on PowerOptions that use Thinkorswim, and they have been for a couple years, and they use the PowerOptions tools. I'll try to inquire from some of them and see what advice they have, and then I can maybe send you an email sometime later next week or in early April. Okay. Doug wants to know, do you have general rules for managing trades using the Greeks, ETC, and exits? Depending on the position, Doug, it all determines the management techniques that I use. That's a very difficult question to answer because it depends on the strategy. I will say this, honestly, I don't use the Greeks at all in 90% of the trades that I make. To me, especially doing the married put technique, the radioactive trading technique, I am more focused on the at-risk amount and my expectation of the stock. When I do trade credit spreads, don't get me wrong, what I said to John about the, what I said to John about the risk-reward ratio and the leverage risk, I will still trade credit spreads from time to time, but I'm focusing more on the probability. I'm focusing more on the range out of the money, for example. I'm not really concerned with theta. It might be a downfall of my trading, but there are things there that don't really match what I'm looking for. In other words, when focusing on the Greeks for things like theta on a credit spread, well, I know that, okay, my theta is here, and tomorrow it's going to change, and then tomorrow it's going to change, and it's going to keep changing as the stock moves. I'm more concerned with the stock staying below my short call strike price, the likelihood of my stock staying below the short call strike price, or it's staying above the short put strike price. I pay attention to delta if I'm doing diagonal spreads. I have traded, and I will continue occasionally to trade diagonal calendar spreads. And I'll pay attention to the delta ratio in that case, but I don't use the delta as an exit technique. If I'm in a credit spread, my personal use is that I'll look to close the spread if the stock reaches within 1 or 1.5% of my short call or short put strike price. Same approach I would use if I was doing an Iron Condor position. If I'm doing the married puts, of course, that's an entirely different rule of thumb. I'm not using the Greeks, for example, but I follow the rules in the blueprint. Now, I do receive this question at other times, Doug, in regards to when I'm showing how I use the PowerOptions search tool to identify married put positions that I might trade. A lot of times I'll have customers ask, well, what delta do you look for? What implied volatility do you look for? What theta do you look for? And I don't. And it's not that I'm not paying attention to it. It's that my base criteria that I use for the stocks and for the put option, where I know that I'm looking for put options that are maybe at least 160 or 180 to 400 days out in time. I want to risk between, let's say, 4 to 7%, and I'm not allowing the put to go more than 15% in the money. By putting in those criteria, and then of course I have 5 or 6 different stock criteria that I use as well, by putting those criteria into the search tool, I can, with about 90% certainty, tell you, well, I know that all the deltas that are going to come up in that search, the deltas are going to be between negative 0.6 to maybe negative 0.75. I can tell you because of the stock selection process I use, my implied volatilities are going to range between about 0.25 and about 0.4, somewhere in that range. Because I'm going in that certain time frame and I'm going a couple strikes in the money, I'm going the 200 days out in time on average, or about 195 days out in time on average, I could tell you that my theta is just going to be between this particular range. So a lot of times the Greeks that I use, the Greeks that I'm not using are actually included in my searches because of the criteria that I use. Okay, let me go back one step. John brought in another question that he was answering to my questions. He says, one of your competitors uses terms such as 3 to 6% return per month for covered calls, 6 to 10% per month using leaps instead of covered calls, using diagonal calendar spreads, and even a higher monthly return for credit spreads. Do you agree with the magnitude of these estimates? If not, do you at least agree with the relative returns by class of trade, more when using leaps versus covered calls? This, wish I would have read this question first, and I could have probably cut down my answers to the other 3 questions by just answering this one. Can we easily identify returns in covered calls that have a 3 to 6% return right now? Yes, I could run the search and identify only those covered calls that had a 3 to 6% monthly return. I could find the 6 to 10% return in the diagonal spreads. No problem. I could find opportunities that might make that return, as we just showed with the spreads as well. Challenge that competitor. Challenge that competitor to show you their portfolios where they've proven that they've made 3 to 6% per month doing covered calls consistently in various markets. Ask them to prove to you that they've done that with leaps. Consistent portfolio, month-by-month basis. And the same thing with the spreads. During recent webinars, Kurt has a poll, or it was last year during a webinar, Kurt would have a poll. We'd have 100 attendees, 90 attendees in every webinar every Tuesday and Thursday at 12 noon. Kurt would ask a couple of simple questions. One would be, for those of you who took a covered call course or a diagonal spread course, were you able to make 3 to 6% per month? And the answers were, my guru claims that he can make that. I've never seen it. My guru's never proven that he's been able to do it. I've come close, but not quite. And I've had more losses that countered all of my gains. 90% of the answers were, I've never seen 3 to 6% per month doing covered calls. My guru has claimed it, but never proven it. That's where 90% of the answers went to. I know what they're claiming. Ask them to prove it. I started trading covered calls when I first started working with PowerOptions. Ernie taught me covered calls. That was my first introduction. Within 4 months of doing covered calls in my personal account, which was small at the time, and I was trading lower price stocks, I moved directly into standard collar spreads because I had 2 months of decent gains, and then I gave everything back in the 3rd month because I had 2 losing positions out of 4. That wiped out everything beforehand. And once I got comfortable enough to start handling the calls from various investments groups that were using PowerOptions, I was getting similar complaints from their clients. Yeah, I've been successful for about 8 months, but the past 2 months I've been only 50% return, and even with the management techniques, I find myself only $500 ahead in my portfolio. When you cap your gains and you allow your losers to, when a covered call, when you cap your gains to maybe 3 to 6%, hey, if the stock moves up and you make that, that's great. But if you don't lock in a limited loss in the downside, if you allow yourself to suffer 10 or 15% losses, you're never going to get ahead. Losing 15%, taking 15 steps back, that you're going to need 5 winning positions to make up for every loss. I've never seen it proven, John. In my 8 years experience looking at other competitors, looking at claims from other investors, seeing certain investors who sell $3,000 seminars and teach books actually go to jail, I've never seen anyone prove that they can consistently every month make 3 to 6%. using diagonal spreads. Never seen anyone prove they can make 6 to 10%. Are there opportunities out there? Absolutely. If everything works out exactly as you expect it to, you could make 6 to 10% on a diagonal spread. That's assuming, of course, the stock's trading right at your short call strike price at the expiration date. Otherwise you have to manage it. Okay, so you didn't make 6% this month, you made 2%. Well, let's try it again next month. Oh, you had a couple of losses. Follow our management techniques. You might end up being in the position for another 4 months. Let's see if we can get that back to a profitable level. I challenge you, I beg you, to ask them to prove that to you. Prove their returns on a year-by-year basis. They've been in business for 8, 9 years. Show them, demand that they show you that they have made 3 to 6% every month over the last 8 years with covered calls, with diagonal spreads, and with credit spreads. And I know who you're talking about, by the way, and I'm not just picking on them. Anyone who claims a guarantee, anyone who says that they will make you, their techniques will make you 3 to 6% per month. First off, right now that's illegal to say anyway, I believe. With the new laws that came out 5 or 6 months ago, it is now illegal for any firm, any investment firm, to claim a promised return on a monthly or yearly basis. That's questionable. All right, that's my rant for the day, guys. I apologize, ladies and gentlemen. It's never been proven to me, and none of my investors, none of our clients that I've talked to have been able to see that either. Even the ones that paid $3,000, $4,000 for a weekend seminar still haven't been able to prove that 3 to 6% per month in covered calls, 6 to 10% per month consistently in diagonal spreads. Those leveraged trades, when you start taking losses, they're going to wipe out your previous gains. All right, Mr. Gary, good to see you online. You've been looking at using the Bollinger Bands and RSI to time stock and options trades in addition to other fundamentals. What chart settings do you recommend for Bollinger Band and RSI? RSI is a tricky one, Gary. We had this little bit about this discussion the other day. I mentioned that RSI, the Relative Strength Index, in general, investors will take a look at the RSI. Let's go to the Mary Put menu here. And they'll look at it as, well, if the RSI is above 80, that might mean that a sign that the stock is overbought and might be primed for a fall. And if the RSI is below 30 or below 20, that means the stock is oversold and is most likely going to come back up. I have a tendency to kind of agree with that. I don't use it, of course, as my main search technique. I don't use that as my main filter. But on average, I'd say that's pretty fair. That's a pretty fair assessment. But there are a lot of contrarian indicators who will go with the opposite, that they'll look for buying opportunities when the RSI is above 80 because they're expecting a breakout on strength. And if the RSI is below 30, they're looking to short positions because they believe the stock's going to fall further or have large gaps down in price. Now, it also depends on your position, Gary, your strategy. There's two ways to look at this. If I'm in a bullish strategy, which we know we know the married puts are. I'm in a bullish strategy. Let me just go to the base radioactive screen instead of these settings I have here. There we go. If I'm in a bullish strategy and I want to look for stocks where the current stock tick is near the upper range of its Bollinger Band because I'm expecting a breakout, I might use that %BB20 range. And this is a reflection of where the current stock price is now in relation to the upper band or the lower band. If it's trading right at the upper band, it would be a BB20 of 100, and if it's a lower band, it would be a BB20 of 0. So let's just go ahead and put in 90 and see if there's any stocks in this list that are up near that upper Bollinger Band. Great, got a lot of them. I'm going to pick on Fossil because I buy their products and I like the stock. And I'm ashamed that I let myself get closed out of the stock at 35 back in August and didn't hold it to where it's at 88.53 right now. Anyway, let's not get into personal stuff. Let's go into big charts here. I'm going to pull up the Bollinger Bands on big charts and take a look. And this is tricky. And this is a good stock to use this on. So I'm going to go into indicators, and I'm going to take a look at the Bollinger Band ranges. Remember, I was looking in married puts. We were assuming a bullish range here. Now here's kind of the trick. There's some times, you see, let's just go back into this range, in August, of course, but back here in June and July. Let me just make sure I circle that area so that everyone can see it. Back here in June and July, in this area, we see that the stock was hitting against the upper Bollinger Band at around $42, $43 per share and then pulled back and dropped down to about $33, $34. Okay, so wait a minute. Wouldn't that mean that if I'm up near the upper Bollinger Band here, it did the same thing back in May? We hit the upper Bollinger Band and then it fell. And then when it broke below it, it moved back up. Well, so does that mean that every time that we're up near the upper band, we should expect a pullback? Well, not necessarily. Here we have a gap up. It was up trading near the upper Bollinger Band. It gapped from 60 to about $68 per share. That's probably an earnings event. It hit the gap here again and kind of pulled back from it. But then when it breached it here, it continued up. And when it hit at the top here, it pulled back a little bit, but then it continued to move up. So sometimes the contrarians will be right, and sometimes looking at it straight where you're looking for the stocks that are hitting the upper Bollinger Band to continue to move up, they're right too. I wish I had a better answer for you, but that's kind of the case. I follow Ernie's rules of thumb on this, and if you wanted to read more about that, what I'm referring to, I don't have it selected. So let me go into the menu here. I'm going to take out, I'll take out collar for the time being. And I'm just going to go ahead and add in long call to my available tabs. Now if you go into the long call menu, the long call home, and the long call or long put home, in the Learning Center, there's an article there for Bollinger Bands for long options. This is the technique, what Ernie wrote up here, this is the technique and the settings I use when I'm using Bollinger Bands for my search. Of course, if I'm bearish, I'm looking for stocks that are near the lower range of their Bollinger Band, and if I'm bullish, I'm looking for stocks that are near the upper range of their Bollinger Band. That's my personal approach. You want to decide for yourself, Gary, if you're going to be direct or contrarian. And even in that, if I'm not mistaken, in that article also, Ernie talks about using the Bollinger Bands, of course, with the SMA 20, or looking for stocks that are above the SMA 20 or the SMA 50, and I believe he briefly discusses RSI in that article as well. So you want to make sure, just go to long call or long put, go in the long call Learning Center, take a look at that Bollinger Bands article, and then, of course, if you have other questions, you can send them an email or give me a call, and then also just join me for next week's presentation. So yeah, I tend to not be contrarian with those indicators there, Gary. So if I'm bullish, if I'm looking for stocks that I think are going to be moving up in price, I'll use that percent BB20 range of greater than 90, maybe greater than 80 even. And if I'm looking for bearish ones, I'll look for a percent Bollinger Band that's maybe less than 20, less than 30. All right, Doug, for trending weeklies, what do you think of doing simultaneous credit calls above and below resistance and support? Credit calls above and below resistance. First off, I'll never do a credit spread that's in the money. I'm not sure if you mean an all call condor, for example. We were doing a bull call debit spread and a bear call credit spread. I don't know if that's what you mean there. Let's go to the custom spread tool and sort of analyze that quickly. Take a look at what we're referring to, Doug. See what you mean. Yeah, I understand. Okay, following up. Let me see if Doug has any follow-up questions. And Harold, I see your question. I'll get to it. Larry, I'll get to your question in a minute. Let's see here. Hold on, guys. Wow, I've got a lot of questions in here. Okay, I'm sorry, guys. We're just getting through this here. We're probably going to be close to 6 o'clock tonight. No problem. All right, so let's go back, and we're going to go into the custom spread menu. And what I want to do is let's pull up, I don't want to use Apple, SLV. It's probably not one of the trending weekly positions, but it probably moves more than you prefer. But let's just use this as an example. Now, I've got, obviously, the Marches I'm not using. Let's take a look at the Aprils. What I think you're referring to here is doing a bear call credit spread on one side. So maybe I'll sell the 38 and buy the 39. And at the same time, a debit spread underneath. If I did a bear call credit spread where, for example, I sold the 34 and bought the 35, well, that wouldn't work. Okay, because now I'm going to have a $1 loss. I'm pretty much guaranteeing myself a $1 loss. I think what you meant was creating an all-call condor by doing the bear call credit spread out of the money and you have to do a bull call debit spread in the money. So in this example, what we're going to do is sell the 38 and sell the 35, buy the 34 and buy the 39. Okay, so I selected my views here. It added into our four-legged field, and I want to sell the 38 and sell the 35. I'm going to do a bull call debit spread with a 35.34 in the money calls and a credit spread out of the money with a 38.39. I'm not going to put in prices here. It's just going to grab the natural prices. I could put in prices, but it's going to grab the natural bid and ask price for me based on if I chose to sell the option or buy the option. All right, so now this is a good explanation of a parity trade. Okay, what we have here is a profit and loss chart of an all call condor using weekly options on SLV. And this goes right back to what we were talking about before, the leverage credit spreads or the leverage debit spreads. What do we see? We're looking to make $13 maximum net credit. We're taking in a net credit of about $8 on the bear call credit spread side, and we're paying a debit here on the other side. And so we'll make this back in between. But you see, on both ends, since we used the same difference in strike prices, we're looking at a maximum profit of $13 and risking 87. Ironically, it's the same spread that we saw earlier when we were analyzing the VIX spread when we did the bear call credit spread, or the same risk-reward ratio. 7% potential gain, but we could lose 46.5% if the stock went above 39 or below 34. And what did we could do? Well, we combined a bull call debit spread on this side by selling the 35 call and buying the 34, and we sold the 38 call and bought the 39 to do bear call credit spread on the other side. Naturally, the goal of this trade is we want the stocks to remain between the two strike prices. As Doug mentioned, if it was trending, would this be a good idea? Yes, but you have to be aware of your risks. You can't allow yourself to take the full loss on one side of the spread or the other. Okay? Now for fun, let's talk about parity trades for a minute. Every options trade has a parity trade. Parity trade to a covered call is a naked put. Parity trade to a bull put credit spread is a bull call debit spread. And a parity trade to a bear call credit spread is a bear put debit spread. So looking at this position, I have a 38.39 in the money bull call debit spread and a 35.34 out of the money bear call credit spread. Well, max return is 7% or $13, and we're risking $87 or 45%, 46.5%, my apologies. All right, now let's clear out our bull call debit spread, and let's compare this with keeping the bear call credit spread, but doing the bull. Oh, I reversed it, didn't I? Shame on me. Hold on one second. Okay, I reversed it. Let's clear all that out. Remember what we had is we had the 38.39 bear call credit spread. We're going to sell the 38 and buy the 39. Now instead of doing the bull call debit spread, what would happen if we sold the 35 put and bought the 34 put? So we did a bear call and a bull put on the same stock, creating an iron condor. Let's go ahead and see what we have here. Wow, look at that. Something interesting happened, didn't it? This is the same exact risk-reward profile. We used the parity trade. Instead of doing the bull call debit spread with the 38 and 39, I'm sorry, the 35 and the 34 call, we did the bull put credit spread. But now our maximum profit is $23 or 13%, and our maximum risk is only $77. You've increased your potential profit here by doing the parity trade, doing the bull put credit spread with the bear call credit spread, creating the iron condor instead of doing the all call condor. That's just fantastic. This is what you always want to do before you enter a trade. You want to compare it to the parity trade. If I'm thinking about doing a bear call credit spread, I'm always going to compare it to the bear put debit spread, because even though they have the same risk reward, they have different obligations, but even though they have the same risk reward profile, one of them might give you a better adjusted return. Larry had written in, do you offer an auto trade service or weekly recommendations? Larry, over at PowerOptions Applied, that's our advisory newsletter service. We don't have a service for the weekly options, unfortunately. Mike Phillips, the head analyst at PowerOptions Applied, he has services for excuse me, services for iron condors, double diagonals, standard collars on the ETFs, and covered calls. But the goal is to go to expiration to expiration. All of the portfolios that he supports are looking 30 days out in time, trading the iron condors and the indexes from expiration to expiration, for example. We don't have one that does the weekly options or makes weekly recommendations. Okay, Harold wants to know, would you please explain the mechanics of a married put at expiration? If the put is in the money and you want to expire the position, do you do anything other than notify your intentions to do so? What do you do with the stock? Okay. Well, first off, Harold, if I'm following the RadioActive Trading Techniques, let's just use SLV as our example here. We'll stay with that. We'll buy 100 shares of SLV, and let's just simulate buying an April put. All right, we'll do just an April at-the-money put, 37 put for now. Okay, so let's just take a look. Now, in this position, probably not a very good one. It's a short-term put, an at-the-money put. I would never trade this myself. I'm just using it, for example, in the risk-reward profile. Maybe I need a better position. Let's get a better position so we can see a little bit more on the graph there. Let's do this. So I'll go out to January, and I want to do the 40 put. Okay, let's see what that looks like. It's probably about a 7-8% risk. 7.7% risk, very well. Okay, so this gives us a little better graph. Now, this is a far out put option, of course, Harold, and the curved red line is showing us the profit and loss at the halfway point. Now, in this setup, you own shares of stock, and you bought a put option which obligates you to deliver shares of stock at expiration. Okay, in this example, we're looking at stocks at $36.39 share price, and we bought a 40 strike put for January 2012. Now, let's just fast forward, assume we made no adjustments on the position and we kept the position all the way to expiration. We would probably never do that if we're following the RadioActive Trading Techniques. You would have gotten out of the put or adjusted it well before that. Okay? Now, but situation occurs. The green line here is our stock price. At January expiration, 2012, let's say the stock's at the same price as at $36.39. If you do not do anything, if you don't close the position, what technically happens for most brokers now, you do want to call your broker and verify how they would handle this internally. But for most brokerage houses, owning an in-the-money put, being long an in-the-money put, if they exercise that for you, it essentially means you're shorting stock. Okay, if you just had a long put in your account and you kept it to expiration, it was in the money and you didn't have shares of stock, on Monday, you would now have 100 short shares of stock at the put strike price. Okay, because when you buy a long put, you're expecting the stock to drop. It's essentially an obligation to sell your shares of stock at that price. So if you don't own stock, your broker would assume you wanted to short stock, in this case, at $40 per share. But since I do have the stock in my account, and this, I've let this happen before, but I shouldn't have done it, but I did let it happen before in another trade. It was EPB. I had a 35 strike put, and the stock was at 34.20 on March expiration, actually. And what my broker did is essentially short shares of stock at 35 and use the long shares I had in my account to cover it, so it essentially cleared out the position. It just looked in my account as if I sold shares of stock at 35. But really what happens is, if you have a long put that's in the money, your broker will look at that and assume that you want to short shares of stock at 35, and then if you have long shares in your account, or in this case you'd short shares of stock at 40, and if we had long shares in our account with a cost basis of $36.39, they would use that to cover the short obligation at 40, which means you'd have a loss of $334 or 7.7%. That's essentially what happens at expiration. You're just delivering your shares of stock. You're exercising the put, you're technically shorting shares of stock, and then you're covering it with the stock that you own in your personal account. Okay, let's see here. All right. Margaret, sorry, do you prefer selling puts to buying calls for a stock that you expect to go up in price? Well, for a stock that I expect to go up in price, Mary, I prefer to use the married put position, which has a similar risk-reward profile to a long call, but I can only trade the long call if I'm disciplined. If I'm expecting a stock to shoot up in price, I'm expecting a 5 to 8% gain in the next 30 to 60 days, I prefer to be using a married put or make sure if I'm doing long calls, I'm only buying the number of contracts that match how many shares of stock I could buy in my account. I never want to overtrade. If I have $5,000 to invest, well, let's take this SLW position, for example. If I wanted to put $5,000 into a trade right now, I'd be able to buy 100 shares at $36.39, maybe buy this January 40 put for $6.95, so my total investment would be $43.34. That dictates that I can only buy 100 shares of stock and one put contract. If I wanted to attempt the parity trade with this, I can't allow myself to risk more than $334. What would it be in the married put position? So I could probably only buy one January 2012 40 put. If I said, well, I have $5,000, why don't I buy 10 contracts of the call, so maybe I'm investing $3,500. Why would I want to risk $3,500 in one trade? That's absolutely ridiculous. I would never do that in my personal account. But fortune favors the bold. If I invested $3,500 in long calls and the stock doubled to 60, well, I'd look like the fool. But the married put would give me the similar monetary profit, so I wouldn't look like that much of a fool. Naked puts, I will use, I think maybe I did misunderstand your question. I'm sorry, I did misunderstand your question. I better grasp of it now. If I wanted to potentially to get into a stock, would I prefer using a long call to potentially buy shares of stock by exercising the call, or allowing the stock to be put to me with a short put? Margaret, that still depends on my expectations of the next 30 to 60 days. If I'm expecting a stock to move up maybe 5 to 8% in the next 30 to 60 days, but I wouldn't mind owning it if it comes back a little bit, I might speculate using the long call, but I'd still compare it to the married put. Most likely I'd do the married put position. Then I'm already in the stock and I've forced myself into a proper trade. If I'm expecting the stock to stagnate a little bit, or I'm not sure, I'm confident that it's not going to decline too much in price and it might be stagnating a little bit or moving up maybe only 2 or 3% over the next 3 or 4 weeks, if it's a good enough premium, I'll use the naked put position. It depends. But however, I'm very hesitant now to just trade naked puts by themselves or covered calls because of that risk, right? Because of the infinite risk. On a covered call, if I bought stock and sold a call, I might generate 4 or 5%. Technically, you know, the stock would need to go bankrupt for this to happen, but technically that still means I'm risking 96% of my invested capital. Same thing with the naked put position. Let's go back to SLV. You know, if I'm looking at, I didn't want to do that. If I'm looking at the April call, I might sell the 35 put, for example. Let's just do a naked put there and hit submit. Same risk-reward profile as a covered call, only a potential of a 2% gain, but if this stock tanks overnight, if it has a sudden gap down overnight, I might be looking at an unrealized 10, 15, or 20% loss. Okay. There's also another problem with this, Margaret, another way to answer this question, I should say. There are also two very different approaches. For example, if I'm selling a naked put, I'm selling short-term, less than 45 days at a time, month by month by month, to increase my annualized return. If I'm buying a call, speculating on owning the stock, I'm buying a call that's 5 or 6 months out in time to have a lower cost per day. I'm not buying a call that's only 30 days out in time. If I thought I was looking at a strong stock that I expect to move up over time and I wouldn't mind owning, and I don't expect any sudden downdraft soon, you might want to consider the naked put position, but I would highly suggest that you trade this as a bull put credit spread as opposed to a naked put, because naked puts in these volatile markets can come back to haunt you. So if I was looking to maybe buy shares of this stock at 35, I didn't mind owning it, I might surrender some of my potential premium by still selling that 35 put, but maybe buying a 30 or a 31 put, for example, to create a bull put credit spread. So now, if the stock drops slightly and is just below 35, okay, well, I'll buy shares of stock, collected a small premium, 58 cents, but I'll buy shares of stock around $35, was trading around 34, maybe 33.50. But if the stock suddenly tanks, if something happens in the market and SLV, the silver ETF, suddenly drops below $32 or $31 per share, I'm not risking that entire amount. I've capped my gains capped my losses slightly. This is still too big of a risk-reward profile for me, a risk-reward ratio. I don't know if I like that. But if you're looking to do a naked put to get into shares of stock, consider doing it as a bull put credit spread so you have some of that coverage there as well. And of course, buying a call, you'd be going further out of time. All right, Doug, on weeklies, your best strategies for high probability, low risk trades. We get this question a lot, and it's kind of interesting to me because there is no difference, in my opinion, of trading weekly options to the standard expiration. So ask yourself, Doug, normal expiration cycles, what are your favorite strategies for high probability, low risk trades? Well, you might consider doing credit spreads. I mean, we kind of showed how that risk-reward works against you, unfortunately. But you can look for high probability positions. I have customers doing the naked puts on the weekly options, or of course the credit spreads. I think most common, Doug, right now, the credit spreads and the iron condors are the most popular strategies for the weekly options. You can screen for that high probability of success. They're not necessarily low risk. Your risk is still, 5 times, 10 times the amount of premium you might receive on the position. But I think those are the most common strategies, the credit spreads and the iron condors for the weekly options, because it works to your benefit. I had a customer call me last week and says, okay, I want to take advantage of these weekly options. What options should I look to buy? And again, as I mentioned at the beginning, the onus is on me because there are no dumb questions. But I had to scratch my head for a minute and discuss with the customer, okay, here's the problem. When you're buying a call, you typically want to go further out in time. Expecting, a 5 to 10% increase on a stock over a 30-day, 60-day period is hard to gauge. Expecting a 5 to 8% gain on a stock in a 6 or 5-day period is very difficult to gauge. And if you can do that, well, you're a better technical analyst than I am, and you probably don't need my help. But that's the key. Now, I don't recommend buying options. There's a lot of fun things that you can manipulate. I've seen some presentations on this, and using the calendar spreads, the diagonal calendar spreads, which John had asked about earlier, using those diagonal spreads where I'm buying an in-the-money leap call and selling at or out of the money calls. I've seen some investors who will buy a 2-month out option, maybe 60 days out. So right now I might be buying the May in-the-money call on a stock that offers weekly options and then selling the at or out of the money call every week. So as the new cycle comes out, I'm selling that new call at it. So instead of buying the 6-month out or 8-month out call and selling near-term calls against it, I'm buying a 2 or 3-month out call and selling the weeklies against it on a regular basis. So the same strategies you feel that have a high probability, low risk of success on the standard option cycles, hey, those are the same strategies you'd want to apply with the weekly options. I highly recommend, though, that when you're analyzing potential for weekly strategies, you're going to be generating premium. As we all know, when we sell month by month by month, we'll get a better annualized return than if we sold the option that's 6 months out and then 6 months later sold it again. Like the option that's 6 months out in time is not 6 times the cost of the near-term option. Same rule applies for the weekly options. If you look at an option chain, if everything stayed the same and you were able to sell the at-the-money strike every week for the next 3 weeks, you'd get a higher return than if you just sold the standard April expiration. So that's how that works for you. But as we talked earlier, remember doing the credit spreads, they can come back to haunt you. All right, John, let's see, what do we have here now? Okay. Oh, John's thanking me for my honest answers during my rant there about the positions. Let's see here. Okay, you always thought that it was legal to claim the clients. That was a new rule. I can't remember if it was 12 months ago or 15 months ago, John, when that rule came out, but I remember reading about it, that there was supposed to be, you could not claim guaranteed returns on any type of position or strategy. And I've seen some of those things. Yeah, and I was referring to Wade Cook when he went to prison for making claims that weren't supported, and he had a lot of his customers suffer losses, and he was charging, I think, $3,000 over the weekends for those seminars. And by the way, that's how Kirk got started. He went to Wade's seminar, paid his $3,000 to learn how to do covered calls and calendar spreads, had good returns in the first couple of months, and then he had one loss, and it wiped out everything. But he didn't give up, and he kept trying to do this. Okay. Oh yeah, and you've attended some of those webinars and you've seen some of those results there where the investors have answered that they'd be more successful if they just limited their losses. I'll try to point you in a direction, John, of one of those other older archives we might have on the site that shows that other poll I mentioned about the 3 to 6% return. John, I thank you for joining me today, and I thank you for your questions. Those were really great questions, and I'm glad we got to talk through that a little bit. Let me check something real quick. I apologize. I saw a couple questions come in that I cannot find right now, and I'm wondering if I maybe went too long. I did. Okay, I apologize. Nancy had a couple questions regarding the technical indicators, and she had to leave. It looks like it's about 5:25, and unfortunately her questions just sort of disappeared after she was out of the webinar for more than 5 minutes, so I apologize for that. I'll have to send Nancy an email later. Okay, we had Larry's questions there as well. All right. Well, I might have mistakenly, I don't think I closed any of the questions that were there. We still have a few minutes left. If anyone else has any follow-up questions, please go ahead and send them over. Margaret, if you wanted a little bit more explanation on what I answered. Jerry, I see that you're here. We had a discussion earlier today, Jerry. If you have any questions, go ahead and send those over. Let's see here. Jamie, Harold, if you wanted any follow-up there. Okay. Margaret, I did answer your question. I do apologize for that. That's kind of a shame. Margaret did have to leave her computer for a minute. She didn't hear the answer that we just went through. Margaret, your question was on, would I use a naked put or a long call to potentially enter into stock if I thought it was moving up in price? Let me know if that was your question, Margaret, if that's what you meant. We had just gone through that, and I went through the description of, okay, great. Now, let's go back to SLV. Okay, this quick review for everyone, and we just talked about it, but I did record this, Margaret. I'll try to post it up on Monday so you can go through that. It would be at about the 5:15 mark, I think, is when I started answering your question. Now, just on a naked put position, remember what we talked about earlier. If I used a naked put, I'm using a shorter term cycle. This also relates to the weekly question that we just had with Doug. You know, if I'm looking to sell premium, it's better to sell it in the shorter time frame to get a better annualized return. So if I'm using naked put positions for the potential to buy shares of stock, I'm probably selling only out 30 days, 45 days at a time. Now, the problem with doing this, same risk reward profile as a covered call, is that I generated some premium which might lower my cost basis if I input the stock. Here we sold the SLV 35 put, so if the stock gets put to us, our cost would be $34.32. But I still have so much risk to contend with if there's a sudden gap or a decline in price. One of the suggestions I made, Mary, is that if you're looking to do these naked put positions, and yes, I wrote a book on naked puts. It had worked for me. It was a strategy I loved, but now, even if I'm using puts to potentially buy shares of stock, rather than just doing a straight naked put, I might enter it as a bull put credit spread. And we talked about how the leverage works against us here in the bull put credit spread as well. But at least if there's a major black swan event or an unexpected event, well, I'm still obligated to buy shares of stock at 35. So if the stock's trading around 33 or 30, or I'm sorry, around 34, 34.50, still generated 52 cents of net credit here. So I'm about at break even. I own the stock. I can turn it into a covered call. But you might want to consider turning it into a bull put spread. So if there is a sudden gap and the stock drops down to $28 or $29 per share, you've at least capped some of the loss you might take on the position. This is still a, what is that there? It's a 5-to-1 risk-reward ratio, so it would still come back to hurt your account, but at least you protected it from being no more than that if you're doing naked puts. Now the comparison that's difficult is I would look to do this if I'm interested in buying shares of stock that I feel are going to be around a trading range over the next 30 to 60 days and maybe further out in time. If I'm expecting the stock to move, then it might move up 5 to 8% over the next 30 to 60 days, or I'm looking for further increased growth or maybe a sudden jump in price. It might behoove me to do a long call because either with the short put or the bull put credit spread, you've capped your gain. With the long call, you still have the unlimited gain, but you can't overtrade. So, you know, if I was considering getting into a stock and faced with this dilemma 5 years ago, I'd say it's going to depend on my expectation of the stock going forward. But nowadays, I won't even consider it a question. This is one of the great advantages of radioactive trading, Margaret, because I can say, well, I think I want to get into silver wheaton. It's at 36.39. I'd like to get it at a better price, and I don't want to risk that much on it. Well, you know what? If I'm still expecting it to move up in price over the next 30 to 60 days, that's a perfect time to open a married put position. I force myself into the only risk amount that I can afford. I still have the unlimited upside, and I'm not concerned if the stock falls because I've got that guaranteed limited risk in place. So it's going to depend on what your expectation is of the stock market and what you think is going to happen next. But if you're considering doing naked puts, I had success with those for a while, but I ended up giving back to the market. So I would suggest analyzing, at least taking a look at what would happen to any naked put position you're thinking about selling. See what it would look like as a bull put credit spread so you can minimize some of your losses if there is a large gap. And instead of doing the long calls, you know I advocate the married puts, but comparing them two together about getting into the stock, it's going to depend on what you expect going forward. Okay, so if you're expecting a great gap and a sudden move, maybe you can use leverage long calls. Just please don't overtrade. Do 2 or 3 contracts. Maybe do 5 contracts. Don't allow the cost of the long calls to be to represent more than 1 or 1.5%, maybe even 2% at most of your entire portfolio value. You can't afford to lose that. You can't afford to risk too much of that in one position. And again, as I mentioned, I'll prefer to do the married put in that situation. Oh, I'm sorry to hear that, Margaret. You did have a recent loss. Well, hopefully the stock comes back up for you there if you're stuck owning the stock right now at the put strike price where the stock was below. And now that you own the stock, there might be some convenient things you can do. Here's a trick. I don't want to say a trick. There are no tricks. Here's something you might consider. You say you recently got hurt on that stock. Go ahead and type in the stock symbol here into your field where you ended up getting the stock put to you, and click on stock repair. Now, the stock repair tool is similar to what some of you might be familiar with income method number 5, that ratio call spread in the blueprint. But what the stock repair will do is if you own shares of stock that have recently dropped in price, you're forced to buy shares of stock at a higher strike price because you had a naked put position and the stock has an unrealized loss. So take a look at this stock repair tool, and it'll prompt you to put in your cost per share and your number of shares. Let's see, silver ETF was at 36.39, right? What would happen? I know you probably have a bigger loss, or you might unfortunately have a bigger loss than this, but let's say we had SLV at 39. We just had 100 shares, and it's now dropped to 36.39. Okay, so what this is showing me, what the repair tool did is we have a unrealized loss right now of about 8.5–9% or so. We put in that we bought stock at 39. It's currently trading at 36.39. Now, what the system tried to calculate for us is doing a ratio spread to help us get back to break even. And so the first one, it tried to build an April spread using the 36 and 37 calls, but it couldn't do it. It couldn't give us a better break even. But there is an example from May. So it shows us we could use the 36 and the 37 call, generate a credit of $1.36, and this lowers our break even down to 36.82, and the stock's at 36.39. Well, that's not bad. Little repair. We'd only need the stock to be trading at 36.82 and May expiration to get back to break even. Well, let's take a look at the repair details first. I'll click on that button. This just gives us the specifics. So I might look to sell 2 May 37 calls for $1.85 and buy 1 May 36 call at $2.34. Now this will give me a net credit of $1.36, so we've lowered our break even to 36.82. Well, if my cost basis is 39 and I collected $1.36, that doesn't work out to 36.82. What happened? Well, here's the trick. Again, there are no tricks. I should stop saying that. If the stock was trading at 36.82 on May expiration, we'd have a loss of $2.18 on our stock. Remember, we paid 39. The stock's now at 36.82, so we have a loss of $2.18. We keep this $1.36 net credit, but remember we bought 136 call and sold 2 37s. So our 36 call would be 82 cents. 82 plus the $1.36 gets us to that 218, so we'd be at a value with our stock at 36.82 and the 82 cents remaining in our long call. The $1.36 we received would give us a value of $39, be break even. But we didn't need the stock to move back to $39. We just need it to be at 36.82. Now, instead of looking at that, apologize, ladies and gentlemen, instead of looking at that numerically, let's go back up to our trade. In addition to clicking on the repair details, which gave us the spread setup where we sold 2 and bought 1, If we click on Analyze Trade, this will bring us to that profit and loss chart. So what do I have here? 100 stocks, 100 shares of stock at 39. Bought one May 36 call for $2.34. Sold two May 37 calls for $1.85. And our break even is now $36.82. Again, why? Well, we collect $1.36 net credit, which lowers our cost basis. If the stock's at $36.82, our 37 calls expire worthless, and we keep and our long call would be worth 82 cents. It gets us back to break even. Instead of needing the stock to go back up to 39, we now only need it to go back up to 36.82. Two problems with the stock repair. One is obvious. We didn't do anything to protect this. We could still lose more. The stock repair assumes that now the stock has dropped, you're expecting it to move back up in price. Stock repair only works if the stock moves up. If the stock continues to fall, we've done nothing to protect the downside on that position. That's a little tricky. The other problem is, well, if it just had a recent drop, you expect it to be trading back up to $39, $40, $41, $42 per share. You've also capped your gain on the May series as well. Okay, so you limited your gain here. You still haven't protected the loss, but you can help yourself find ways to get back to break even a little bit. Okay. Yeah, and it will try to calculate various expirations for you, Margaret, on the stock repair tool. You might see if there's a significant loss. I've seen positions that had a 15-point loss but still had a repair out to January 2012. And again, remember, that's assuming that the stock is at least trading back up at this break-even price of $36.82. If it continues to fall or it stays at the same price, well, we still have a loss in the position. But it helps it a little bit, and it can get you back to break even if the stock does move back up. All right. Well, it's about 5:45, 5:47. Now let me go back to our slide presentation. If anyone has any last-minute questions, go ahead and send those to us, and we'll just try to address those very quickly. For those of you not familiar with subscription cost, of course, the 20-minute delayed service to PowerOptions is $59.95 per month, or $600 for the year. The real-time service is $79.90 per month, or $800 for the year. Now, the back-testing tools aren't included on the standard levels of service. You can access a 3-month. You can get 3 months access to the historical tools for $99.95 per month. If you're already on the real-time service, it's actually cheaper just to upgrade to the professional level of service. It's only $20 more per month. You don't need to be a registered advisor to take advantage of the professional level of service. So it's only $20 more. This gives the professional level of service gives you access to everything you had on the real-time service, but with unlimited access to the historical suite of tools. All right, the upcoming webinar events every Tuesday and Thursday at 12 noon Eastern Time. Kurt hosts his Introduction to Radioactive Trading. If any of you, of course, today had questions about radioactive trading that you wanted to go a little bit more in depth on or ask Kurt, join us next Tuesday or next Thursday at 12 noon Eastern Time. Or if not, just send us an email, of course, to support radioactive trading. Next Friday, 4:30 p.m. Eastern Time, I'll still be here. I might have fun next Friday. It's going to be April 1st, so I might try to pull some April Fool's jokes, but I'm really not that sinister, so I doubt I'll do that. But next Friday at 4:30 will be our open discussion. And remember, you can view the archived presentations at any time. Just go to powerop.com/webinars.asp, and you can also access that from the Learning Center menu. And, of course, if you have questions, send me an email, support@powerop.com, or you can reach us toll-free during market hours at 877-992-7971. or at 302-992-7971. All right, Margaret, have a great weekend as well. Thank you for the great questions. Good to see you here. Doug, appreciate the quality. Just learning equity options, and this is one of the first, this is one of the best sites I've found. I'm glad to hear that, Doug. Anytime you have any questions, you just give me a call, even if you haven't signed up for a trial yet. But if you do sign up for the trial, the 14-day free trial, remember you can sign up for a coaching session at any time. The coaching sessions are completely free. It's essentially a 40 to 50-minute phone conversation with myself or Ernie. We'll answer any questions that you have, guide you to archived webinars, which might go to your questions also. And yeah, just give me a call anytime, send me an email. And when you get started on your trial, just make sure you sign up for one of those coaching sessions. That applies to everyone online, too. If you're currently on a trial or a subscriber, make sure you register for one of those free coaching sessions. John, you said a lot of great things. You had a lot of great questions, and you sent that really positive and really glowing feedback about the answers that I gave there. I'm sorry I didn't read it word for word, but of course I'm a little shy. But I appreciate your comments on that, and I'm glad that you appreciated my answers. It was great having you here, and I appreciate the questions. And I really wish I could give you a better answer, John, on what is the expected return on the given strategies. I've been trading options for 8 years. I talked to about 20 to 30 customers a day. What I've unfortunately found is there's no way to ever express what is an expected return, because the minute you find a strategy and it works for you for 4 months and you're able to generate even 4 or 5% in a given strategy, in a month or two the market's going to turn on you, and the strategy that was so successful for 4 months is not going to be successful. You're going to have to change the way you think. Why do I advocate standard collars and radioactive trading? It's because of the fact that limited risk is guaranteed. These are the closest strategies I've found that work in most markets. I'll be honest with you, I don't think there's any one strategy that works in every market condition. These two, in my 8 years of trading, everything I've learned and talked to about box spreads, ratio spreads, double diagonal back spreads, ratio call spreads, ratio back spreads, all these other different names that we could throw out, I've never seen one strategy work in every market on a consistent basis. And you got to be able to adjust, you got to be able to adapt. But the married put technique, the RPM technique, radioactive trading technique with the 10 income methods gives us enough flexibility. At least we have a limited risk. So if we're wrong, we're not in this problem where we had 4 months of successful trades making 4 or 5% on our trades each month, and then the next 2 months we only had a 50% win-loss ratio and we ended up giving everything back. We're protected against that in the married put technique. And with standard collars as well, but standard collars are more of a hit or miss trade. Have the similar risk-reward profile to a bull put credit spread or a bull call debit spread, but because I'm not using a leveraged spread, I'm actually invested in the stock, and I sold a call and I bought an out-of-the-money put. If I'm wrong, I only lose 6% of my capital, which I still don't allow to represent more than 1.5 or 2% of my total portfolio. And if I'm right, I might make 2.5 or 3%. That again is on the standard collar position. But with that setup, if I'm right, I make 2.5 to 3%. If I'm wrong, I lose 6%. I still have to be right about 67% of the time in order to make money. I typically use the standard collars I'm referring to augment my portfolio with the radioactive trading technique. So I use that to generate some income, not necessarily on the same stocks I'm trading in an RPM, in a radioactive trading technique, but as a way to just generate regular monthly income. And if I'm wrong, again, I lose 6%, but I'm making sure that's not more than 2 or 2.5%. But John, I really appreciate you joining us today, and I really appreciate your questions. And again, I wish I had a better answer for you, and I'll work on it. The market does everything it can to make us wrong. That's right, John. That's unfortunate, but that is actually right. And the way to counter that, of course, is to control the only thing we can control, and that's to control the risk. I can't control that I'm going to be right 80 or 90% of the time. I can look for positions that have an 80 or 90% probability, but I cannot control that in the market. I can't control how much I'm going to make in the market. I can look for positions where I'm expecting to make a 5 or 6% return. Some might return that. Some might not have any change, and some might have a loss. The only thing I can control is how much loss I'm willing to give back to the market by using puts on insurance, on my stocks. My stock positions and even spread positions, they are an investment. And like any other investment, you want to insure those positions. You want to protect those positions so that you're not suffering catastrophic losses. All right. Ladies and gentlemen, thank you again for joining me this afternoon. I hope you all have a fantastic weekend. We'll see you hopefully next week at 4:30 Eastern Time for the open discussion presentation on April 1st, April Fool's Day. Again, I might do something a little colorful, but I highly doubt it, but we'll see, won't we? All right, ladies and gentlemen, take care. I did record this presentation. I hope to have it up maybe Monday afternoon in the PowerOptions archives. So take care, everyone, and we'll see you soon. Good night.